Hearing. The hearing is entitled Bond Rating Agencies Examining the Nationally Recognized Statistical Rating Organizations. I want to thank the witnesses and members for accommodating the votes on the floor and convening at a different time. And I want to mention that quite a number of bills have been, and discussion drafts have been listed as being under consideration at today's hearing. I noticed that some of those bills are Democratic, put forward by Democratic authors. Some are bipartisan, and I would encourage my Republican colleagues to submit bills to be considered at our various subcommittee hearings. Without objection, all members have 5 legislative days within which to submit additional questions for the witnesses. You submit those to the chair. They'll be forwarded to the witnesses for their response. I ask witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. I remind members that written questions and materials for the record should be submitted to the email address which has been provided to your offices. I will now recognize myself for 4 minutes for an opening statement. Americans say the economy is the most important thing. In a free market system, the allocation of capital is the most important thing in the economy. That's why we call it capitalism. The people think that the most important institutions at the national level are the president and Congress. I believe they're the Fed, the Financial Accounting Standards Board, and the bond rating agencies. Notice I use the term bond rating agencies because I don't want to use credit rating agencies and confuse them with those who rate the credit worthiness of individuals. The term NRSRO, statistical organizations, is a misnomer, since what they do is hardly just statistical or as objective as a statistician. The allocation of capital is of critical importance. About $250 billion in capital is allocated through our equity markets, and we follow those very carefully. What's the stock market doing? That provides $250 billion to businesses to conduct business. 20 times as much money flows through the debt instruments that are rated by the bond rating agencies: corporate bonds, commercial paper, asset-backed securities, municipal bonds. Those ratings determine what gets funded and at what interest rate. If the rating is too low, the bond will yield a high rate of interest, the project won't pencil out, and the factory will not be built. If the bond rating for a package of mortgages is too low and the interest rate is too high, you will not qualify for the loan. Bond rating agencies earn roughly $14 billion from our society to do their work. Their ratings are confusing, except to the insiders. They should be clear to outsiders. From the largest agency, the 5th best rating is A+. Why would ordinary people think A+ is the 5th best? And of course, the 4th best from the other agency is capital A, small a3. Not only that, the ratings are not defined. What is the estimated risk of loss with an A+ rating? We don't know. There is an unchecked conflict of interest. The issuer selects the credit rating agency and pays them, say, $1 million to give them a grade. Trust me, if you pay me $1 million, I will give you a good grade. So this is, we saw them give very high grades to first and second mortgages for people who couldn't afford to make the payments. And that is why the Financial Crisis Inquiry Commission stated that the inflated ratings given to mortgage-backed securities were a primary cause of the greatest economic catastrophe I have lived through. I call it an unchecked conflict of interest because there's no liability. In every other field, a professional who conducts malpractice gets sued. In this case, there's no check on the desire to give a high rating and make the issuer happy because because of the protection from liability. In Dodd-Frank, we ruled that at least with regard to ABS securities, there would be liability. The bond rating agencies went on strike. The SEC issued a no action letter declaring they wouldn't enforce our law, and the bond rating agencies won, proving that they are indeed more powerful than Congress. I now yield for an opening statement of, I believe, 5 minutes to the ranking member.
Thank you, Chair Sherman. Well, I'm afraid, respectfully, this hearing is another example of dusting off outdated ideas in search of a problem. Everyone here today agrees investors' over-reliance on credit ratings is one of the many factors that led to the 2008 financial crisis. And the Dodd-Frank Act significantly expanded the scope of regulation and accountability of rating agencies. Since we last had this discussion a number of years ago, it's important that we separate a few facts from the fiction. Fact: credit rating agencies face potential conflicts of interest regardless of whether issuers, investors, or governments pay for those ratings. This idea that there's a model that does not present a conflict of any sort just is false. As long as there's a party interested in the outcome of a rating, there is going to be a potential conflict, and the federal government can certainly be a conflicted, interested party as well. Fact: nearly 10 years ago, the Democrat-led SEC studied many potential credit rating agency compensation models, as well as the feasibility and desirability of standardizing the credit rating industry as required by Dodd-Frank. After a thorough review, public comment, and a public roundtable, the SEC staff did not mandate any structural changes to the issuer pays model. Fact: the SEC's more recent examinations indicate that rating agencies are managing potential conflicts and producing ratings that benefit investors and issuers. If credit ratings agencies fail to do so, the SEC has the right tools to intervene when necessary. And I parenthetically might add, if someone is doing something purely because they are getting paid for it, there's some legal responsibilities and obligations that need to be pursued, and there should be ramifications for that. So to imply that anyone can just get bought in this is a sad state of affairs, and they need to be gone after. Fact: during the pandemic, the rating agencies responded to evolving market and economic conditions promptly and effectively, performed their role as independent providers of forward-looking information. Given these facts, you may be asking yourself, why are we here today? The answer, I'm afraid, is some want to relitigate Dodd-Frank, a bill that they jammed through more than a decade ago without as much as acknowledging what has transpired over the past decade. Former Democrat Commissioner Roel Campos said it best. Quote, "It is not the time for an untested government-engineered credit ratings market. The credit markets and the resulting information to investors is too important for laboratory experiments." Closed quote. I will echo yet another voice from the Progressive Policy Institute, fairly left-wing and not one that I would normally cite. But this group, Progressive Policy Institute, had this to say. Quote, the credit ratings market, based on the issuer pays model, seems to have a way to consistently produce high quality and more accurate ratings that give strong and useful signals to market participants. Nobody has been able to come up with an alternative compensation model that is clearly better. Close quote. I urge my colleagues to focus our efforts on real, modern problems, and let's just not rehash a fight that's over decades old. I know that there are some who are trying to say that there's a number of problems, there's issues that somehow having institutional investors do their own due diligence indicative of their lack of trust in the ratings that are there? Well, credit ratings are designed to augment and to be a tool, not simply to replace separate analysis. And it would seem to me that as we go and tackle some of these issues, we all realize and understand there is no one singular source that we can go to get all of this crystal ball read in a manner that is perfect. We don't live in a perfect world. The COVID situation is a great example of that, as people were guessing what the future was going to look like, and they were having to do their best estimates with what they were dealing with. So with that, I'd like to yield back the rest of my time.
Now recognize the chair of the full committee for 1 minute.
Thank you, Mr. Sherman. In the lead up to the 2008 financial crisis, the bond rating agencies assigned AAA ratings to worthless mortgage-backed securities and complex products created by Wall Street, all the while knowing that retirees, cities and towns, and investors around the world relied on their ratings to make investment decisions. Their ratings brought our financial system to its knees. Millions of people lost their jobs, their homes, and their life savings, not to mention costing the economy trillions of dollars. 11 years later, many of the Dodd-Frank reforms for rating agencies remain unfinished, including addressing a central conflict of interest wherein the same companies selling securities continue to shop around for their preferred ratings. With the financial risk that climate change and the pandemic now pose, investors need objective and reliable ratings more than ever. So I look forward to this discussion, and I want to thank Mr. Sherman for putting the time and attention on this issue that's certainly needed. But we are looking forward to seeing how we can improve this critical part of our capital markets. I yield back.
Thank you. Before introducing our witnesses, let me introduce the two witnesses who refused to be here. Douglas Peterson, President and CEO of S&P Global, and Rob Farber, President and CEO of Moody's Corporation. Even when they realized they didn't even have any commute time to be here, they've refused our request. That's why I'm appreciative of the witnesses who are here, starting with Ms. Amy Copeland McGarrity, the Chief Investment Officer of the Colorado Public Employees Retirement Association. Next, we will have Ian Linnell, President of Fitch Rating, the third largest agency, who is showing a respect for Congress by being here that I really appreciate. Next, we will have Jim Nadler, Chief Executive Officer of Kroll Bond Rating Agency. Next, we will have Robert J. Rhee, a professor with the University of Florida Law School. And finally, we'll have Mr. Michael Bright, the Chief Executive Officer of the Structured Finance Association. Witnesses are reminded that their oral testimony will be limited to 5 minutes. Their written testimony will be part of the record in full. You should be able to see a timer on the desk in front of you or indicated on your screen that will indicate how much time you have left. When you have 1 minute remaining, a yellow light should appear. I would ask that you be mindful of the timer, and when the red light appears, wrap up very quickly so that we can be respectful of everyone's time. Without objection, as I mentioned before, your written statement will be part of the record. Ms. McGarrity, you are now recognized for 5 minutes.
Chairman Sherman, Ranking Member Huizenga, and members of the subcommittee, thank you for the opportunity to speak with you today. My name is Amy McGarrity, and I serve as the Chief Investment Officer for the Colorado Public Employees Retirement Association, which we call PARA. I'm going to summarize my written remarks, and I ask them to be included in the hearing record. PARA is a public pension plan serving more than 620,000 current and former public employees and their beneficiaries with over $60 billion in assets. Unlike many other pensions, we manage over 60% of our assets in-house, so we are allocating to asset classes while also selecting specific securities. In fact, our more than $12 billion in fixed income assets are managed entirely in-house by our investment professionals. Pairs investors typically look well beyond the credit ratings and other assessments of securities provided by the ratings agencies. Thus, while a particular credit rating may be a component of our investment decision-making process, our team also conducts proprietary fundamental and relative value analysis in order to derive our investment decisions. Put simply, we try to look beyond the ratings because we don't always have confidence in them, and we typically have the ability and resources to do so. Credit ratings also impact our investments indirectly, such as being used as a screen for inclusion or exclusion due to a particular portfolio benchmark index. Lastly, our portfolios have internal guidelines which may refer to a credit ratings and allowed securities. But let's remember the purpose of credit ratings. Credit ratings are intended to provide investors and other market participants with accurate assessments of the risk of a default. That credit risk could arise for any reason, ranging from traditional business risks, a global pandemic, or simply having trouble filling orders because of microchip or worker shortages. Further, to the extent that credit ratings provided by NRSROs may be inaccurate, that may lead some investors to mispricing their risks and inefficiently allocating their capital. This will impact different investors differently. Make no mistake, large, sophisticated market participants with the resources and expertise needed to make accurate credit risk assessments may benefit from the mispricing of assets by those who may be more dependent upon ratings for their pricing determinations. By now, we all know that tens of thousands of asset-backed securities were rated AAA in the run-up to the GFC, and thousands of them would be relatively quickly downgraded to junk status, and huge percentages of them actually defaulted. Clearly, something was wrong. Several government investigations and enforcement actions, numerous civil lawsuits, and widespread press reports eventually all confirmed what many of us now accept. The ratings weren't reliable. Bipartisan efforts to reform the industry and improve ratings accuracy were floated, and ultimately a slew of reforms were included in the Dodd-Frank Act. However, significant questions regarding rating agency independence remain, and the ratings marketplace remains highly concentrated. While much work has been done, the SEC never adopted a ratings assignment system, nor did it propose changes to the issuer pay model. I have spent much time in the last few years exploring these problems. In addition to my role at PARA, I've had the honor of being appointed by then SEC Chairman Clayton to serve on the SEC's Fixed Income Market Structure Advisory Committee and was asked to chair its credit ratings subcommittee. In our subcommittee, we explored the issuer pay business model and ways to address that clear conflict of interest, as well as other ways to improve credit ratings quality. As part of that process, the credit ratings subcommittee released a draft discussion document that would have created an assignment process to reduce the issuer pay conflict of interest. While we ultimately could not get consensus on that issue amongst the members of the FIMSAC, we nevertheless were able to get consensus on other recommendations, including increasing rating agency disclosures regarding models and deviations, enhancing issuer disclosures for how they select ratings firms to assess both corporate securities and securitized products, and establishing a mechanism for bondholders to vote on the issuer selected ratings firms. These are valuable proposed reforms, but in my opinion, not nearly enough. The core of the issue with credit ratings remains the conflicts of interest associated with issuers both choosing and paying for their own ratings. The SEC should consider establishing a ratings assignment process that would offer enhanced opportunities for smaller rating agencies and reduce incentive for rating inflation. And there should also be greater efforts to ensure rating agency accountability. I appreciate that this subcommittee and the SEC are again exploring ways to improve the accuracy of ratings to better protect investors, but also drive more fair, orderly, and efficient markets. Less conflicted and higher quality credit ratings would benefit PARA and the markets overall. Thank you for the opportunity to speak with you today, and I look forward to questions.
Thank you for your brevity. We'll now hear from Mr. Linnell.
Thank you, Chairman Sherman, Ranking Member Huizenga, and distinguished members of the subcommittee. My name is Ian Linnell, and I'm the President of Fitch Ratings. I appreciate the invitation to appear before you to talk about Fitch Ratings and the role of credit rating agencies in the capital markets. Credit ratings provide a forward-looking and relative opinion on credit risk, namely how likely investors will be repaid in full and on time. Credit risk is an important factor when considering whether to buy a bond. Unfortunately, for a variety of reasons, some investors do not adequately assess credit risk. Fitch helps to make sense of credit risk with ratings based on a simple letter scale. AAA is the highest rating, indicating the least credit risk, and single D is the lowest rating. We have over 2,000 employees working in over 30 countries, including over 1,250 analysts. Fitch, part of the Fitch Group and a wholly owned subsidiary of Hearst Corporation, is dedicated to providing the financial markets with timely, independent, and objective credit ratings. In the wake of the 2007 financial crisis, Congress passed the Dodd-Frank Act in 2010. Congress designed many of the provisions of Dodd-Frank to address concerns about credit rating process that regulators believed contributed to the financial crisis. Even before Dodd-Frank's requirements went into effect, Fitch had implemented a variety of changes to its business designed to address many of the same concerns, including separating the analysts who evaluate credit risk and prepare our ratings from those employees who manage our business relationships with issuers, establishing a compliance department to ensure we are following our procedures in developing ratings, appointing a chief credit officer who is independent of the analyst to oversee the development and updating of our methodologies, and putting in place an independent review of our criteria. The changes made in advance of Dodd-Frank positioned Fitch well to comply with the requirements of the new law. Dodd-Frank also created the Office of Credit Ratings, the OCR, that the Securities and Exchange Commission launched in June 2012. The Commission charged the OCR with administering the rules of the Commission and overseeing the practice of NRSROs, promoting accuracy in credit ratings, and working to ensure that they are not unduly influenced by conflicts of interest. The OCR conducts annual and other examinations of NRSROs to assess and promote compliance with statutory and Commission requirements and routinely monitors the activities of NRSROs. The OCR and its staff are solely dedicated to the oversight, examination, and supervision of credit rating agencies. In addition to US regulations, credit rating agencies are subject to the regulatory mandates outside of the US, including the European Securities and Markets Authority and the UK's Financial Conduct Authority. The EU has enacted its own registration and oversight system and related rules for rating agencies. Other nations have adopted similar measures. As a result, Fitch, along with the other global rating agencies, is subject to regulation and examination in every single country in which it operates. Fitch believes that the global regulatory framework created since Dodd-Frank has brought greater transparency and rigor to the credit rating process. The regulations respect the analytical independence of rating agencies by being procedural and not substantive in nature. The current law strikes the right balance between ensuring proper government oversight while maintaining the rating agency's ability to express their opinions without undue government interference and free competition and choice in the marketplace. We appreciate that there is interest in Congress to expand on the framework of Dodd-Frank with further regulation related to credit ratings. Fitch welcomes changes that would improve the public's understanding of and confidence in credit ratings. However, the proposals that we understand are under consideration are concerning to us and could, in our view, have negative consequences for securities markets, NRSROs, and investors who rely on our ratings for an independent assessment of risk. I address these concerns more fully in my written testimony. Thank you for your time and the work that you do for the United States, and I welcome any questions that you may have. Thank you.
Thank you. We now move on to Mr. Nadler, Chief Executive Officer of Kroll Bond Rating Agency.
Chairman Sherman, Ranking Member Huizenga, and members of the subcommittee, thank you for the opportunity to testify today. I'm Jim Nadler. I'm the CEO of Kroll Bond Rating Agency. KBRA was founded on the premise that open competition helps protect investors and can increase market liquidity. KBRA is a full-service rating agency and one of the 5 largest rating agencies globally, and the largest rating agency established since the financial crisis. We believe that KBRA's entry in the market has been hugely positive for investors. 2 excellent examples of the positive impact of competition and our innovation are in the community bank and ESG spaces. Despite our success over the past 10 years, we still face barriers to competition. The 3 largest NRSROs still command over 95% market share and are written into the plumbing of the financial system. An example of this includes the investment guidelines of institutional investors that specifically name only the incumbent agencies. We believe that all investor guidelines across financial markets should permit the use of any SEC-registered NRSRO. Another example is the recent Federal Reserve emergency lending facilities, which initially required the use of the rating by one of only 3 large rating agencies. As a result of the intervention of members of this committee, the House passed legislation requiring the Federal Reserve and the Treasury to accept securities rated by any NRSRO registered with the SEC. We support broadening that legislation to ensure that no government agency can limit competition. I would also like to offer an input to the Commercial Credit Rating Reform Act that is being discussed today. We appreciate Representative Sherman's longstanding leadership on issue of competition and NRSROs. That said, we have concerns regarding unintended consequences of this legislation. While government assignment of ratings would increase the market share of smaller NRSROs, like mine, it would discourage thorough research. If an NRSRO is assured of receiving regular rating assignments via government panel, some might not devote resources to quality research. That would be detrimental to investors who would lose access to diverse, transparent, and thorough market information. Mr. Chairman, we believe that many components of the Dodd-Frank Act have been highly successful and have all served to improve outcomes for investors, including increased disclosure, the required development of internal controls, and supervision and annual examination by the SEC. In addition, the requirement that NRSOs publicly post their methodologies and substantive changes thereto allows investors to familiarize themselves and scrutinize methodologies and determine which methodologies align with their viewpoint. This is a positive change that protects investors and allows them to play an active role in pushing NRSROs to maintain high and relevant standards. We understand that some policymakers, including members of the subcommittee, have questions about potential conflicts of interest in the issuer pay model. As a general matter, I believe it is not possible to completely eliminate all potential conflicts in the NRSRO space, regardless of the issuer pay or investor pay model, and that the current SEC disclosure requirements mitigate potential risks in this area. We are concerned that views on the issuer pay model were also driven partly by a false narrative regarding rating inflation and competition in the structured finance space that is based on incomplete data and poor media reporting. Our data shows that competition improves research and ratings and does not inflate ratings. We also have concerns that investor pay model would disadvantage smaller investors. The benefit of issuer pay ratings is that the issuers typically make those ratings publicly available to all investors, large and small, that can benefit from the ratings and research published by the NRSRO. We believe that the investor pay model would solely benefit the largest institutional investors who can afford to pay for multiple ratings and the best research available. Finally, Mr. Chairman, we believe the current SEC regulatory framework provides the appropriate level of liability for NRSROs. I thank you and the subcommittee for the opportunity to testify today, and I look forward to any questions.
Thank you for disrupting the oligopoly. And I now want to move on to Robert Rhee, professor at the University of Florida Law School.
My name is Robert Rhee, and I'm here at your invitation to testify as a witness. I thank the subcommittee for the opportunity to be heard. Reform of the credit rating industry is an important subject of Congress's attention. Rating agencies are important market institutions and gatekeepers. The perceived problems of rating agencies have long percolated. Critics have argued that they have long underperformed with little accountability. The proper functioning of rating agency is not only a matter of markets and money, it is a matter of national security. Economic stability is a matter of national security. No country is immune from instability in the credit market. Also, due to the many factors, including the COVID-19 pandemic, countries are more brittle and vulnerable than before. We can ill afford another financial crisis. The importance of rating agencies is underscored by the fact that they pose a deep problem of public policy. A survey of scholarly literature shows a strong line of thought about the nature of the problem. First, many commentators have identified the issuer pay model. Second, many commentators have identified the industry concentration. These factors compound to produce bad outcomes. The rating industry is not competitive, and the incentives are poor. The policy goal, should be to elicit a race to the top, which means a competition for the most accurate bias-free ratings. Competitiveness depends on the right incentives. The incentives currently are not robust. In the staff memorandum, 5 draft bills were identified for discussion today. I believe that each of these proposed bills has merit and good purpose. I comment briefly on each. The Commercial Credit Rating Reform Act mandates a lottery system of engagement with consideration given to certain merit-based factors. This proposed bill has much merit. It represents a sharp move away from the problematic issuer pay model and reduces poor incentives. The Uniform Treatment Act permits the Federal Reserve to not use credit ratings if they are unreliable or not in the public interest. This exception recognizes that ordinary credit analysis may not be relevant in transitory periods of high uncertainty or exogenous shock where ordinary market values and information signals may not be reliable. The Federal Reserve should have the ultimate discretion to use or not use credit ratings based on the public interest. The Transparency and Accountability Act would prohibit the current SEC practice of shielding the identity of non-complying firms. This bill would impose no regulatory cost on the industry. Because the number of credit ratings is an independent factor, meaning that deficiencies of individual firms would not affect the demand for credit ratings, the regulatory and economic effect on the industry would be nil. The Restoring Accountability Act would nullify a no-action letter issued by the SEC that shields rating agencies from Section 11 liability under the Securities Act of 1933. Despite a clear mandate in the Dodd-Frank Act, the SEC provided a no-action letters permitting the deemed exclusion of credit ratings from registration statements. While the issue of enhanced liability is complex, I believe that exposure to Section 11 liability would result in the expenditure of greater care and due diligence by the rating agencies. Lastly, the Accurate Climate Risk Information Act requires disclosure of climate risk. A disclosure approach is compelling. Rating agencies should consider climate risk or explain to regulators and the public why they believe climate risk is immaterial to credit risk. Ultimately, a climate risk disclosure may influence the efficient allocation of capital in the capital markets in an era of climate change. So in summary, past reform of credit rating industry has been incomplete. The 5 proposed bills contemplated by the House Subcommittee advance the goal towards a more complete reform of the credit rating industry. Thank you for the opportunity to be heard and your attention.
Thank you. And now our final witness, Michael Bright.
Sherman, Ranking Member Huizenga, and other members of the subcommittee. My name is Michael Bright, CEO of the Structured Finance Association, or SFA. On behalf of the member companies of SFA, I thank you for inviting me to testify today. The Structured Finance Association is a consensus-driven trade association with over 370 institutional members. We represent the entire value chain of the securitization market, from loan origination to secondary market trading. This market provides over $15 trillion of capital to consumers and businesses. Our members facilitate credit and capital formation across a wide breadth of asset classes, such as auto loans, mortgage loans, student loans, commercial real estate, and business loans. Our members include issuers and investors, rating agencies, data and analytical firms, law firms, servicers, accounting firms, and trustees, among others. Our investor members are fiduciaries to their clients. Before we take any advocacy position, our governance requires us to achieve consensus by agreement rather than a simple majority vote, ensuring that the perspectives of all our diverse membership are included in our policy views. As a trade association, we also take a leading role in helping to craft best practices across the institutions and asset classes that we represent. Turning to the NRSRO process itself, some of the discussion drafts provided to us in conjunction with today's hearing would possibly represent a sea change to how our capital markets operate. It will take some time for our members to analyze these discussion draft provisions, and we are happy to convene our issuer and investor members to discuss them further. As always, we will do so in a methodical and dispassionate way. Importantly, our members believe that it is straightforward to understand and conclude that the issuer pay model creates a potential for conflicts of interest. When assessing what rating agency to engage, our members know that issuers consider a variety of factors. These include the rating agency's criteria and historical performance, the historical volatility of the rating agency's ratings, investor demand for the rating, among others. Our members also appreciate the comprehensive changes to the oversight regime for NRSROs that have been adopted since the financial crisis. We hope that the focus for regulators can be to continue to build upon the transparency and the controls put in place over the past decade. In response to the SEC's FIMSAC discussion papers last year, our members ruminated at length over the pros and cons of alternative compensation schemes for new issue securities. We discussed an investor subscription model and an assignment model. In both cases, issuers and investors both found that those alternative models presented new potential conflicts of interest, while not materially improving the credit rating process overall. Nevertheless, SFA members welcome continued dialogue to consider additional means that could further strengthen disclosure practices so that investors can be armed with all the information needed to make informed investment decisions on behalf of their customers. For example, investors are always receptive to additional information from issuers on how and why they selected a particular NRSRO. An area where SFA is also working closely with our issuers, investors, and rating agencies is around ESG disclosure for our markets. Sometimes called sustainable investing or impact investing, we have seen a major influx of retail investor demand for products that can be labeled with these terms. Our primary concern at the moment is that the markets must keep up with the demand without degrading standards. To that end, SFA is working hard to build best practices for disclosures and reporting that can be used by the securitization markets. We very much look forward to working with this committee on these issues in the years to come. In conclusion, it is important to make abundantly clear that the members of the Structured Finance Association are committed to being part of the healthy progression of our markets and their regulatory infrastructure. We aim to provide responsible lending and investment opportunities for all American communities, households, and businesses. We are absolutely determined to bring more gender and racial diversity to the decision-making corridors of our industry, as we see this as essential to the functioning and continued evolution of our markets and our economy. And we support all efforts to debate and discuss ways to enhance the regulation and transparency of our industry and the markets it serves. Our members take seriously the role that they play in the American as well as global economy. We know that the decisions we make, models we employ, and controls we build have a direct and meaningful impact on the lives of millions of people. For those reasons, I thank you again for the opportunity to discuss this important issue with you today, and I look forward to answering any questions you may have.
Thank you. Without objection, we'll enter into the record a letter from Better Markets in support of a system in which there would be a panel of bond rating agencies, and the SEC would select which one is applicable. I'll now recognize myself for 5 minutes for questioning. We're told by those who want no reform at all that the answer is simple: just ignore the bond rating. That begs the question, why are we as a society paying $14 billion for ratings we're not supposed to rely on? But it also is incredibly unfair to the individual investor. If you have $50,000 to invest, how are you supposed to select which bonds to invest in if you can't rely on the bond rating? Are you really supposed to go out and visit the company? Likewise, if you're trying to choose which bond fund to invest in, and both of them average a AA rating on their portfolio, and one yields 2.1 and one yields 2.2, on what basis would you not just invest in the one that with the higher yield and the same rating? Are you really supposed to review the 400 or 500 portfolio holdings of each bond fund and decide on your own what the appropriate rating of each one of those bonds are? The fact is, we need bond rating agencies, and we need reliable ones. I agree with the ranking member when he says that when people screw up, there should be ramifications. And I want to again point out that the Financial Crisis Inquiry Commission, established by Congress to look at the greatest economic disaster in our history, the history of those of us born after 1933, found that the rating agencies inflated mortgage-backed securities and other asset-based securities, and that this was a primary cause of the 2008 financial crisis. All I can say is that the system we have now would be for baseball as if the home team selected the umpire and each umpire was paid $1 million per game. Under such circumstances, Kershaw would know every ball time Kershaw pitched the ball, it would be a strike. Congress tried in Dodd-Frank to require the bond rating agencies to accept some liability. I have a proposal that actually is less severe in terms of the liability, in that it would apply liability only if there was a showing of gross negligence. Mr. Nadler, if for you to do business, you had to accept that you would be sued if there was a showing of gross negligence, would you stay in business or would you go on strike the way the bond rating agencies did in 2010?
I have to look at that more carefully. I think that the point that you're making is that there needs to be consequences for bad behavior. And as I outlined in the written comments, and I tried to talk about in my opening statement, for us, it looks as though the framework that Dodd-Frank has set up, added, in conjunction with the 33 Act, the 34 Act, and the 40 Act, are sufficient to create an environment where rating agencies are encouraged and could realize that they could suffer penalties by not.
I thank you for your answer. I'm going to try to squeeze in one more question. Mr. Linnell, this is an easier question because it won't cost you a penny or subject you to any liability. Right now, for one of the rating agencies, the biggest, their 5th best rating is an A+. For another one, the 4th best rating is big A, small a, 3. Now, if my kids come back from school with a grade of A13 omega epsilon, I'm not going to know what it is, even though educators might. Do you see any harm, or what harm do you see, if every credit rating agency gave an A+ to the best, and then an A, and an A- and a B+, so that the ratings could be understood by somebody who's a parent, not somebody who apparently works on Wall Street?
Well, I think that partly there's a few answers to that, but the main one is that our credit ratings are meant for professional investors. They're not meant for the retail level, for the man or woman on the street. And the professional investor pretty much understands the ratings definitions and the rating scales that we provide, because we've been providing them for
my time has expired. I'll simply say that as an investor, I'm paying you the $14 billion and I deserve something I can understand. I will now recognize the gentleman from Michigan, the ranking member, Mr. Huizenga.
Thanks, Mr. Chairman. Mr. Linnell, Mr. Nadler, I think you're the only 2 practitioners on the panel of actually operating a rating agency. I'm curious, what is your price?
Did you say what is your price? Sorry, I missed that.
Yeah, what is your price? Because it's been implied that for $1 million, a rating agency will pass and put a good rating on. Much like if you paid the umpire $1 million, they'd throw a game. So I'm just curious if you're for sale.
Well, if I may take the first stab at that, clearly there is no price.
It can be a short step. It could be a yes or a no.
There is no price to compromise our reputation.
Ratings based on what you get paid.
There is no price you can pay high enough to compromise the quality and the reputation of us as a rating agency.
Okay. How about Mr. Nadler with Kroll?
That's exactly this. I have the exact same answer, and I'd add one thing, and that is that if the games were televised, people would very quickly stop watching them.
Okay.
And I think that's sort of.
I think you're right. Well, so Mr. Nadler, I'd like to stick with you because I think in your written testimony, and I'm summarizing it here, but I just want you to expound on it maybe a little bit. You're saying that some sort of rotational system, which you, I believe, is as the 5th largest, but a bit smaller than the others, would actually help your business. But what I heard is it wouldn't necessarily help your profession. Is that correct?
I think that's right. I think that competition has been one of the driving force for better transparency, better research, and I can talk about a number of areas where we have led the industry toward better research through being a viable competitor.
All right, great, thank you. And by the way, I'm happy to hear that you're not for sale and you're not going to throw your ratings, no matter what that price tag is, because that's certainly what has been discussed. And if that is the case, in my mind, that's illegal, and it should be punished. So I want to move on. Mr. Bright, you've been involved on all sides of the market for a number of years. And I'm curious, lots of discussion about 2008 and the crash and effects of 2009 and into 9 and 10. So very, very briefly, what's changed between 2008 and today?
An understanding that the underlying asset prices can go down. That was probably the number one mistake made by everyone, bank regulators to securities regulators prior to 2008. So I think we have better knowledgeable assumptions coupled with a lot of changes in regulation and the passage of Dodd-Frank.
And do you believe that investors have an adequate voice in these discussions?
We try to make sure so.
What do you hear from your members who buy bonds daily?
Well, I would definitely say that they will tell you that they have a very good dialogue with both the issuers and the rating agencies. So I think the rating agencies almost see the investor as their customer quite a bit. So they subject themselves to as many qualitative questions as they can answer from them.
And do you believe that fixed income markets are working efficiently, and do they believe in the integrity and the resiliency of the ratings?
Certainly, substantially more so now. A lot of fixed income investments in the United States are currently purchased by the Fed, but a lot has changed in the last 10 years for sure.
Okay. Mr. Linnell, as former Democrat SEC Commissioner Orwell Campos stated regarding the potential system of a new government-supervised ratings, he said, quote, "Such a system would not necessarily be preferable to dealing with the existing CRA conflicts of interest through today's careful supervision by the SEC, where investors pay for ratings that affect their portfolio values," close quote. How would a government entity assess the performance of credit ratings?
I think that's a perennial challenge for any policymaker or regulator, given the very nature of credit ratings being opinions. But the way that the market has traditionally gone around that, and other regulators and authorities, is by looking at the level of transparency that agencies give around the performance of their credit ratings over a period of time. So you'll see now that there is substantially additional disclosure at a very granular level around the performance of credit ratings, default statistics, migration statistics, huge amount of information that is available, and most of it is freely available on websites. So it's around transparency and disclosure around performance is the typical way that the market assesses the relative performance of rating agencies.
The gentleman's time has expired. The gentleman from Illinois, who's also chair of the Artificial Intelligence Task Force, Mr. Foster, is now recognized for 5 minutes.
Thank you, Mr. Chair, and thank you for your attention to this important subject, which is one of the unfinished items left over from Dodd-Frank. So first, could anyone explain to me what the downside of standardizing the 3-letter ratings would be, and potentially associating each rating with a range of default probabilities under industry standard stress scenarios? Why is that a bad idea? How would that hurt things?
standardization in and of itself won't change anything. And I don't see anything particularly wrong with standardization. I think that the rating agencies do a good job of putting information and descriptions around each of the ratings that talk about default frequency assigned to a certain rating. So I think that's already part of the system. But from standardization, I don't see. I think it would be something that would be benign for the industry.
And what about assigning default probabilities under industry standard stress scenarios that so you can actually, hold up after a crisis has occurred, compare the prediction with what actually happened in terms of the observed default rates following a crisis? It's my understanding that was done in the past, I think prior to maybe the mid-90s or something like that. There used to be default probabilities associated with ratings. And somehow that doesn't seem to happen anymore. And I was wondering why returning to that might, as well as standardization, might be a bad idea.
Well, if I may add, ratings agencies do publish quite comprehensive PD data, default data associated with each of its ratings and ratings categories. But the agencies don't define those ratings according to those PDs. And the reason why you don't define them according to a specific PD set is because you're trying to look through economic cycles, and obviously default rates will change with cycles, and therefore the ratings will become quite volatile, and you'll exacerbate pro-cyclicality. But many users do indeed find the PD rates associated with a given rating level as being very useful in their decision-making process, and that's why the rating agencies provide them in a very granular and detailed way. And as I said before, it's freely available. So from a large extent, investors are getting best of both worlds. They're getting the qualitative rating scale that the credit rating agency scale traditionally provides, as well as the transparency and insight for performance on a PD basis.
So that's interesting. I was unaware that you could actually take, actually predict what the default rate was going to be based on. If you have some portfolio bonds, that you could actually go and look at the three-letter ratings and say, therefore, it should hold up this well under this scenario for an economic downturn. I think at the end of this, what the real ultimate answer may be to publish the models and predict how individual classes of bonds with a certain rating might perform under certain well-defined stress scenarios. Very much the way big banks go through a variety of stress tests, and they make sure that their overall capitalization is robust against a variety of stress scenarios. That's providing that sort of information to users, and potentially just letting them, run an app that looks at their bond portfolios, run the models provided by the industry, should ultimately allow them to know whatever portfolio they're holding, how you guys predict it should hold up, and then if they see a big difference, actually, be able to have something to discuss after that. So what are the possibilities that people have discussed for putting some skin in the game? For example, by requiring rating agencies to simply carry insurance against the possibility that the ratings turn out to be, not so good. And so that with the insurance payout, for example, would be going to the investors that have been harmed by bad ratings. It seems to me that would provide whoever provided that insurance with a really well-motivated, independent look at the accuracy of your ratings and their best guess as to how accurate they are. So are there mechanisms like that have been proposed to make sure that there's really an independent set of eyes and give a profit motive to finding mistakes that your industry is making? Any observations of all the different mechanisms that people?
I would, if I may, I would say that the ultimate sanction on poor performance of ratings from a rating agency is that rating agency would or should be fairly quickly out of business. The only asset rating agencies have is its reputation for the quality of the ratings it provides and its associated and supporting analytics. In terms of any punitive regime, as I was mentioning before, we are very heavily regulated now in nearly every single country that we operate in, and all of those regulators have a
Time has
finance.
expired and more than expired. Hate to cut you off, but you can add to the record with the rest of your answer. The gentlewoman from Missouri, Ms. Wagner. Mrs. Wagner is recognized for 5 minutes.
I thank you, Mr. Chairman. One of the factors that led to the 2008 financial crisis was investors' over-reliance on credit ratings to evaluate the risk of structured finance products. However, credit rating agencies are just one of many, many causes of the financial crisis. Between 2008 and 2009, the three largest rating agencies undertook a number of steps to reform the ratings process, including reviews of originator due diligence, improved ratings methodologies, and increased disclosures to investors regarding their ratings. In 2010, with the passage of Dodd-Frank, these nationally recognized statistical rating organizations, or NRSROs, were hit with new requirements aimed at enhancing their disclosures and transparency. Unfortunately, this blanket approach to annual reporting requirements mandated under Section 932 of Dodd-Frank placed unnecessary burdens and compliance costs on small credit rating agencies that were in no way responsible for the financial crisis. After the Office of Credit Ratings was created in 2012 and the new requirements went into place, smaller credit ratings agencies have been prevented from entering the marketplace and providing necessary competition. Contrary to what some may think, more regulation does not solve everything. That is why this week I have reintroduced the Risk-Based Credit Examinations Act with Congressman Foster, and this bill makes the criteria required for annual reporting by the NRSROs just that, risk-based. A move to a risk-based model will alleviate the burden on small credit rating agencies while continuing to maintain oversight and transparency over the industry. The marketplace needs this fix. Former SEC Chair Mary Jo White has spoken in support of the SEC moving to a risk-based approach. Likewise, former SEC Commissioner Gallagher has also previously highlighted how burdensome the Dodd-Frank regulatory requirements will be. And as a result, smaller credit rating agencies have to devote more resources to compliance than the largest credit rating agencies. I want to be clear. This bill does not eliminate reporting requirements for credit rating agencies. Instead, it simply makes the criteria required in annual reports risk-based. Credit rating agencies will still be held accountable while allowing real competition in the market. I want to thank Congressman Foster for his support of this issue since, frankly, the 114th Congress. Mr. Linnell, in my limited time, will you describe the environment in the rating industry since the 2008 financial crisis? Is it more or less competitive?
Simply put, more competitive. Before the financial crisis, really, Fitch was the biggest and traditional competitor to what was really seen by many participants as a duopoly of S&P and Moody's. So Fitch has grown substantially since 1997 through a series of mergers, acquisitions, and substantial organic investment. So we were the main competitor in the market, but since then, we've seen the growth of other agencies. And in fact, until recently, there was 6 very active rating agencies in the structured finance space, for example. I say 6 recently because we're now down to 5 following the merger of DBRS and Morningstar. But Kroll and DBRS are now taking 20% market share. It's a very competitive market.
Thank you, Mr. Linnell. Mr. Bright, in 2011, the SEC approved more than 500 pages of proposed rules to implement the provisions in Dodd-Frank for NRSROs. The proposed rules required NRSROs to have effective internal governance mechanisms related to how the NSRO determined the credit ratings and to provide annual reports to the SEC. Since then, can you describe the performance of credit ratings?
Even especially looking at the recent COVID crisis, the volatility of them has substantially decreased since these initiatives have taken place.
Have they improved since 20?
Well, that would be the way I would define improvement, yes, is that they're more reliable, especially in the face of a major economic event such as the COVID-19 crisis.
My time has expired. Mr. Chairman, I shall yield back. I thank the witnesses.
Thank you. We now recognize the Vice Chairman of this subcommittee, Mr. Caston, for 5 minutes.
Thank you, Mr. Chairman. Thank you to all our witnesses. I want to talk a little bit about climate risk. I've been spending a lot of time thinking about the risks in our financial system that climate poses, and I want to start if I could with you, Mr. Nadler, because you mentioned it in your written testimony. And I want to be clear. I don't know the answer to any of the questions I'm about to ask, and I recognize that you all are focused on the dead end of the financial system. We've got a lot of other moving pieces, but I'd like to understand to what degree the private sector is already doing calculations we don't need to repeat, and to what degree there may be some gaps. So that's sort of the spirit of the question. Mr. Nadler, in your written testimony, you said, I'd like to provide some views on climate risk and credit ratings. KBRA fully incorporates ESG risks. I just want to understand, do you evaluate climate risks in your products independent of ESG, or is it only as a subset of ESG?
We evaluate anything, including climate risk, that impacts the credit rating. We include that in the analysis of the credit rating. We also are working with issuers across the board, financial institutions, structured finance credit rating, to begin to include more disclosure around credit risk, around ESG risk, including all ESG risk, climate change, social risk, governance risk, that may not impact the credit today, but could have an impact on the credit in the future, or could impact the market liquidity of the bonds in the future. So we are looking at both including factors that directly affect the credit, but also working with investors, with issuers, to include more disclosure across the board around ESG.
Okay, and I want to separate from ESG because, with ESG, you maybe you're improving on E, but worse on S, and now you've got a complication of how you score it. So looking just at climate risk, do you differentiate between transition risks and physical risks? So in other words, you're exposed to flooding as one set of risks. You're exposed to loss of market to cleaner technologies as another risk. Do you differentiate between those in your analyses?
We do.
Mr. Linnell, do you guys include climate risk, and do you differentiate between transition and physical?
We don't try. The focus of our analysis is, do the ESG factors affect the default behavior of the future risk of the company? And if we think it's a credit issue, then it's incorporated into the analysis. The way that this is obviously a very fast moving space, we actually assign what we call ESG relevance scores from a scale of 1, where these factors are irrelevant.
I just want to focus on climate, not ESG. Right?
Okay.
There are parts of the country that are at physical risk of climate that we know where those are. And I'm just asking, do you include that in your analysis?
Yes, and we score it between 1 and 5. 5 means it's been a key rating driver. 1 means it's irrelevant.
Okay, so back to Mr. Nadler, if I could. If you are including those physical risks, leaving aside the transitional, are there geographies in the United States where you are downgrading in the absence of some greater insurance product at this point that we should be sensitive to as we think about capital movements around the country?
I think it is. We haven't seen downgrades yet. What we've seen is that there is more attention both on the positive side, where we're seeing investor issuers that are much more interested in the changes that are taking place, and they're putting in motion particular procedures or setting aside money to take care of that. And we're also having better conversations among issuers about those risks that now that we incorporate them in the current rating. I do think as this climate risk becomes more understandable, we are going to see a divergence in ratings for cities, towns that are more resilient.
I'm sorry to cut you off, but we're getting to the end of my time. I'm really not asking a judgment question, but like we're sitting here with wildfires raging across the country with huge flooding events. And are you telling me that knowing what we know, knowing that's coming, that we are not yet downgrading any of those credits, or we're not yet requiring greater insurance? So who bears that risk of loss right now? Do investors understand that in your ratings?
KBRA doesn't yet have a broad portfolio of municipal ratings, so I defer to the rating agencies that have large municipal ratings throughout the country.
Well, thank you. I'm out of time, but would love to continue the conversation. I yield back.
The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
I thank the chairman, appreciate calling this hearing and know of his significant passion and work on this issue for improvements for many, many years, and appreciate the expertise of our witnesses. Mr. Bright, as I look at the draft legislation that we have before us, explain to me some of the limitations, in your view, from using this rotational model to try to assign credit ratings.
So I think a dynamic that we want to harness and build upon, and to be clear, we do support as much additional transparency and governance and controls as possible, as feasible, to ensure that rating agencies are publishing criteria and any changes to their criteria and selection process issuers are using. So just as a baseline, but there's a very healthy tension that is built into a system of issuers having to sell their bond to an investor with a particular rating, and then the rating agency needing to explain to their investor the methodology that they use, the criteria that they use, and the investors very much appreciate that discussion and that dialogue, and it can be a two-way feedback, and that helps to make sure that they're not making criteria too conservative just to cover themselves, or not too weak just to win business. It's more of a discussion that brings to bear a lot of market forces. And I think that you want to build upon that tension to continue to improve the process. If it was simply a selection criteria where once you meet some basic minimum threshold, all of a sudden you're now in this rotation system, I would worry, and I know more importantly than that, our investors would worry that would eliminate the incentive for the rating agency to work with them to improve the quality of the ratings and the reliability of their model.
Thanks for that. That's helpful. And it makes me think about my work in investment banking, and I've got a great associate who's worked for me, who's great training at Bank of America Merrill Lynch. And in all of our experiences, one of those deals before they go public that was just a primary objective was that any true deal had to have 2 ratings from the big 3 agencies, or the public investing community wouldn't take the transaction seriously. So, Mr. Linnell, can you speak to this? It's addition to what I asked Mr. Bright. Can you specifically talk about how the rotational model that would only produce 1 rating would undercut that opportunity to have 2 independent looks at a particular investment for investors?
Well, I think the reason why people wanted 2 ratings from the big agencies is because they wanted to see high quality ratings, which typically comes from those agencies in that they have a demonstrable track record, they have large coverage, and they have execution capability to give what the issuer and the investor requires. I think when we look at what the proposal that is on the table, we continue to believe that investors are best served by agencies competing with each other on the quality of the work that they actually do, making the ratings as predictive as possible, having them supported by high quality analytics and research, not allocated by a particular board or body. And it's by competing in this way that standards improve and that transparency improves, and that way that the users of ratings understand how they've been determined, what do they mean. And it's this transparency in performance that ultimately eliminates rating shopping and not allocation from the board.
Yeah, that's helpful. And I'm always dubious about a one-size-fits-all sort of governmental solution without that market touch and that market competition. So that's kind of where I come from on this. And But there's an ongoing responsibility that these credit agencies have and perform in our capital market system. So, Mr. Nadler, can you discuss the important role that the credit rating process plays in surveilling the companies or the issuers that they've actually rated? So that ongoing surveillance responsibility.
Absolutely. One of the most important aspects of what rating agencies do is this ongoing surveillance. And I think that was one of the breakdowns in the financial crisis, was this feedback loop of looking at what's going on during the surveillance period and using that to help you with your primary research. And so it's critical, this role in surveilling. And I think that one of the things you worry about in an assigned rating regime is that rating agencies will spend less time and less money on this surveillance aspect.
Thank you. And Mr. Chairman, I appreciate the time and the witness's expertise, and I yield back.
Thank you. And I do want to clarify for the record that the legislative proposal before us does not prevent an issuer from getting a second rating from any rating agency they like. With that, I recognize the gentleman from Missouri, Mr. Cleaver, who is also chair of the Subcommittee on Housing, Community Development, and Insurance, for 5 minutes.
Thank you, Mr. Chairman, and thank you for doing this hearing. I think it's important. I want to follow up on Mr. Foster's questioning because it intrigued me. I've been on the Housing and Insurance Subcommittee for almost 18 years, and he raised a question about ensuring your ratings and what happens in terms of insurance, or if things go as they did in 2008, that the ratings go awry, we have an economic collapse. What would be wrong with requiring that you insure your ratings?
I was just going to say, I think the point I think that I would make to that is, credit ratings are essentially a prediction of the future. What is going to happen in 10 years, 15, 20 years time? We do our best job to do that and make sure people understand how we've come to that decision and what's supporting that analysis and the credit rating. But it's essentially a prediction about the future. So I would probably find that insurance companies, to insure your predictions with 100% accuracy, is going to be prohibitively expensive. So I just don't think it would necessarily work from a practical perspective.
Yeah, I was on this committee. I'm probably the only one in here who was still here when we had the credit rating agencies sitting here in 2008, or actually maybe 2008, and everything was great, and so we took your prediction literally and ended up in trouble. Plus, no insurance company in the world would do the insurance, as you probably know, and then they would want to have a government backstop, which wouldn't happen either. Let me move over on something else, Professor Rhee and Ms. McGarrity. Mr. Rhee, you mentioned in your testimony about the vigorous, the policy and should be vigorous competition for the most accurate and bias-free ratings, and that we have not included in any kind of legislation anything that would incentivize the industry to be a little more active and careful, active but careful in the bias-free ratings. And you also said that it is not robust at the present time. I'd like to ask you and Ms. McGarrity, what else do we need to do? What, if you could write something out for Congress to do, a to-do list on these credit rating agencies, what would it be? What's not there that we should have there?
Well, the fundamental structure of the credit rating agency, I don't believe has really changed that much prior to from 2008 to now. You look at the dominance of the rating agencies, you look at the compensation model, they're essentially the same. And so there's a question of whether or not we want to promote a race to the top or a race to the bottom. I think competition needs to be defined in terms of competition for what? Competition for revenues or competition for the best quality? And so I think to answer your question, Congressman, I would like to see a competition for a link between compensation and performance. In other words, pay for performance. And so I would say that that would be my answer.
Ms. McGarrity?
From my perspective, I put forward a number of ideas through my written testimony, but at the heart of the problem, in my opinion, is the issuer pay model. So I support also pay for performance and generating additional competition in the industry and reduce the oligopoly or the market segmentation that doesn't exist, the market fragmentation that doesn't exist, and support of the smaller market players.
I hate to get into it, Mr. Chairman, because my time is running out, so I will yield back the balance of my time.
Thank you. We now recognize the gentleman from Texas, Mr. Taylor.
Thank you, Mr. Chairman. I think this is an important topic, and I appreciate the opportunity to visit it. I think we should visit it more often. So I guess I'll start with a comment that ratings are important, but it's imperfect. I think that two different people, very bright, capable, can look at the exact same data set and come to different conclusions. And so analytics is ultimately imperfect because it is human. So I think we should begin with that. I guess where I grow concerned is when the analytics become a groupthink. And I'll go back to the collateralized mortgage-backed securities industry, something I'm familiar with, where you looked at the subordination levels. So the AAA piece got bigger and bigger and bigger going into 2008. And so that allowed for more aggressive pricing of loan products to the borrowers and higher leverage levels. The underwriting was weakened, and then you came into a crisis in 2008. And so I guess just one thing that, as I was going through the written testimony, for Mr. Nadler, you said that rating a false narrative regarding ratings, inflation, and competition, incomplete data, and poor reporting. Could you clarify for me what you mean by that? Because I certainly, in my business experience, have seen, groupthink, and I think, what we saw in CMBS and other products, you just saw subordination levels decline. You saw the rating agencies, basically fall down on the job.
So what I was referring to was an article that was written about pre-crisis and post-crisis. And the narrative of the article was that rating agencies post-crisis competition had created rating inflation. And it was specifically talking about the commercial mortgage-backed securities market and the part of the market where they put together a group of commercial loans. And in fact, the data, it doesn't support that. But before the crisis, there was ostensibly 3 rating agencies, and the average BBB credit enhancement level, or what you would call the BBB risk assignment or default probability, was about 3.5% to 4%. Post-crisis, when there were 6 rating agencies, now there are 5. That number has doubled, and leverage in the industry has gone down. Same is true of the AAA tranche notes. During the pre-crisis, when there were fewer rating agencies, from today it's about double what it was post-crisis. So it's hard for me to understand how they made it.
I understand where you're going, and I guess I would again iterate, it isn't so much that you're going to be imperfect in your ratings, and I get that. No one is perfect in their ratings because it's ultimately a human endeavor. My concern is when there's groupthink and you watch subordination levels decline, and then you set up investors to go into a product that is not correctly it's not correctly structured, and then your pricing goes wrong. And I'll make this comment, in the real estate crises of the 80s and in 2008 were both presaged by over-lending and over-borrowing. In some level, the poor rating efforts led to the over-lending because the lower subordination levels allowed for lower pricing, weaker underwriting, and the underwriting agencies on some level, I'm looking to you to tell me, yeah, these guys were underwriting less effectively. I don't know if you want to defend yourselves on that point, but that was my experience of what I saw in the markets leading up to the crisis in 2008.
May I add one or two comments on these points?
Sure.
I'd just say that, there is always a danger of group think, and that's why I think efforts to harmonize too much between, criteria and rating agency scales and so on could actually increase systemic risk in a financial system. But, there is actually significant differences between the rating agencies. Sometimes the aggregated statistics can show a different story. But, going into the financial crisis, for example, we were actually tightening the amount of credit enhancement that was required in US residential-backed securities. We weren't active in the structured investment vehicle market because we wouldn't rate higher than single A. It was a triple A market. We had a very small share in the CDO market, in synthetic CDOs, because our criteria was more conservative. And so was our subprime RMBS criteria as well. And then today, a good example.
I'm sorry to cut you off.
Your time has expired. Now I recognize Mr. Vargas for 5 minutes.
Thank you very much, Mr. Chairman, for holding this hearing. I know you have a deep interest in this. I appreciate it very much. I guess I would start with this. My good friend, Mr. Huizenga, we had the honor of meeting his son today. It was a thrill. That was very nice. Meet your son today. That was great. He asked a question and said, what has changed from 2008 to 2010? And Mr. Bright, I think you answered that you found out that prices and values can go down. And then something about Dodd-Frank also, there's some changes in there. I would say that, prospectively, what are the things that could potentially be on the horizon? I would say two. One, the issue of climate change in particular, and also cybersecurity or cyber crime. Those are the two that really would get me. I would add those on. But I would say this, it was interesting, or I'd ask this. It was interesting, my good friend, Mr. Caston, asked the question, are you downgrading any parts of the country, in geographical parts of the country, with respect to either transitional risk or physical risks? And I think you all said, that, well, not all, but the two that were actually involved in the rating agency said no. But I looked up Fitch ratings here, March 2021, with respect to PG&E. And you did downgrade PG&E, Pacific Gas and Electric, in the Bay Area because of the wildfires there, the catastrophic wildfires, and they filed Chapter 11, as you know, back in, 2019, because of the potential liability. And I would associate those wildfires with climate change, climate risk. So that being said, maybe you haven't downgraded geographical areas, but I think you certainly have taken a look at companies. Is that not the case, Mr. Linnell?
Yeah, I actually did say that we assess environmental, social, and governance factors specifically as they reflect and affect credit risk in companies, and we actually score them. Where 1 is it's irrelevant, and 5, it's been a key rating driver. And we have changed many ratings as a result of companies being given a 5 in the environmental issues. But actually, when you look at the whole ESG spectrum, social issues and poor governance are typically more significant rating factors that you see often than environmental factors. So, all 3 of those issues are important when you're looking at credit risk.
I'm glad you said that, because I had a bill that we passed out of here that dealt exactly with ESG. Next time we'll remember to add you onto the list of those witnesses. So thank you for testifying. I appreciate it. I'll remember you, of course. And thank you for your bravery of being here. I guess the other one's chickened out. I would ask this then. How should we incorporate ESG? Mr. Bright, I saw here that you write almost entirely investor demanding this, that we do ESG. It's not really driven by politics or you call it regulatory fiat. I would say that there are some of us that are very interested in this. So how would you incorporate it? Because I think it is one of the issues that we're going to have to face, and dramatically. If you take a look at PG&E, how it was downgraded, I think appropriately so, because there is this risk of wildfire that is associated, I don't care what anybody says, it is associated with climate change. We do have climate change, and it's dangerous. Go ahead, Mr.
Really quickly, for this committee, something you can do is have FEMA update the NFIP maps, which is something that really keeps getting punted. So since I never miss an opportunity to upset the realtors, I figured I'd mention that while I was here today. But
Fair enough.
The ESG work that we're doing, and I think and the point that I was making is that younger investors have this insatiable demand for sustainable certified asset investments. And I think that that is a really great thing. Where I'm
Me too.
Absolutely. The concern that we have as an association is that it's almost so big that it sounds comical. You look at numbers like $74 trillion of US domiciled assets are labeled as sustainable, and that just seems completely bogus. It can't be. So what I'm worried about is that these things degrade so much that people are putting stamps on something that aren't actually meaningful, and then investors become cynical, and we lose this opportunity to certify it. So there's a regulatory role, legislative role, and a market role, in my opinion.
My time is almost over, so I have to just reclaim. I would agree with everything you said, with the exception potentially it's not comical. If you take a look at what happened in Germany, if you take a look at what's happening out in the West, it's real and it's big and it's dangerous, and the numbers are gigantic. And again, I thank you very much for being here. My time has expired. I yield back. Thank you.
Thank you. We now recognize the very patient gentleman from Wisconsin, Mr. Stile.
Thank you very much, Mr. Chairman. Just to follow up, if I can, Mr. Linnell, real quick, to my previous colleagues' comments discussing what's in and what's out of the ratings analysis. Do you have a materiality standard for what you include and what you don't include in those ratings?
So in terms of the E, or just in the credit ratings in general?
Just in your credit ratings in general, as you look at things that you're considering inside the ratings, their materiality threshold for you.
That's entirely the matter of the credit committee, and the credit committee is composed of credit analysts who have got years of experience.
Not trying to get deeper in the weeds, but there is a materiality threshold as you look at some of these factors in your. It's just, I think, a relevant point for this committee to always keep in mind the importance of materiality. Yeah. I'm going to continue on because I have limited time, but I'll stick with you if I can, Mr. Linnell. In your testimony, you outlined some of the changes made to the ratings industry after 2008 that have improved the reliability of those ratings. And last year, those reforms were really tested as our economy experienced a severe contraction due to the global pandemic. And the circumstances were obviously very different than the previous recession, but the NRSROs were also on probably a more solid footing. And the SEC noted in a July 2020 statement by their COVID-19 working group, they said, quote, in addition to substantially different economic conditions and stresses, the relevant analytical assumptions and methodologies used by rating agencies in that period were also substantially different. Could you highlight what changes had the biggest impact on your firm's performance through 2020?
Well, I think, post Dodd-Frank, there was a huge amount of changes. Obviously, as I've mentioned before, we're heavily regulated, subject to annual inspections, and we have 30 different regulators around the world. But Dodd-Frank also meant that we significantly invested in our controls and procedures around the rating policies, and also invested in procedures around managing conflicts of interest. And in addition to that, away from just the control infrastructure, we invested a lot of time and effort in really trying to explain to investors and to issuers what were the key rating drivers, what are the key rating sensitivities. So a lot more effort to try and explain, what were the driving risk factors behind credit ratings. We also make much more effort.
On risk of letting you go on for the whole time, I just appreciate highlighting a few of those. I'm going to shift gears, if I can, to Mr. Bright. Much of today's conversations focus on the issues, the potential conflict of interest inherent in the selection process for NRSROs. We all recognize that conflicts of interest can be a problem, but we can hopefully also mitigate these with good oversight. How do market participants account for the potential bias arising for some of the conflicts of interest? Can you shed some light on this for us?
Yeah, investors, our investors, first off, have a dialogue with the rating agencies, and they will very gladly point out when they think something is wrong. And then they, vote with their feet and with their money. And so I've read some studies that show that certain rating agencies or certain tranches that have only a single rating, they are issued at higher yields, which is what you would expect if the process is not working. So we want to make sure that there's as much governance internally, but as much transparency as investors say that they need in order to understand why a rating agency was selected. They do that in a variety of ways right now. And so that's what I would focus on.
So to shift gears on that, if you look at the market share for existing and NR SROs, clear that some specialize in analyzing certain industries or asset classes. So for instance, AM Best, which accounts for less than half of 1% of all credit ratings, issues about 34, call it about a third of ratings in the insurance industry, more than S&P, Moody's, or Fitch. And so with an assignment model, which is being discussed here, that it really seems to ignore the specialization or other relevant factors, would that lead to a more or less reliable credit rating?
We believe strongly it would be less reliable.
And so your members are the end users of some of these credit ratings. Are they advocating for some of these pretty drastic changes proposed by some of my colleagues?
No, they're not. And many of them are members of the FinTech Commission that looked at this last year as well, which did not advocate for this.
I appreciate your feedback. Cognizant of my time, Mr. Chairman, I will yield back.
Thank you. Now recognize Mr. Hollingsworth from Indiana.
Well, good afternoon. I appreciate everyone being here. One of my favorite quotes about predicting the future comes from a famous economist, Mr. Galbraith, who said, "There are two kinds of forecasters, those who don't know and those who don't know they don't know." I've heard a plethora of comments today characterizing credit agencies as poor forecasters. Even the most notable, false and hyperbolic, pointed to CRAs as the primary, quote unquote, cause of the 2008 financial crisis. These assertions certainly stop short of offering any meaningful alternatives that have proven consistently correct, or at least nearer in their rectitude than the CRAs. To state that CRAs have been wrong is to compare them to what? We can't simply compare them against what we now know, looking back, but instead should look for contemporaneous forecasts or forecasters who proved more correct in forecasting the future. Many of my colleagues across the aisle stop short of this because the alternative doesn't exist. So we have proposed here something that has no evidence of being further correct in those forecasts. We've mobilized the CRA's lack of rectitude, quote unquote, a characteristic that can also be attributed to federal government agencies, banks, economists, consultants, academic researchers, et cetera, and then state that lack of rectitude must mean that there's a latent bias that needs rectifying, needs correcting, a diagnosis that is surely incorrect, and not shockingly, we have the wrong cure. Specifically, I want to talk about one question that keeps coming up. I keep hearing from my friends across the aisle as though these credit agencies have no incentive whatsoever to be right in rating these particular issuances. There have been, Mr. Linnell and Mr. Nadler, there have been several accusations made today about credit agencies inflating ratings or otherwise providing incorrect credit ratings as an attempt to maintain consumers, or alternatively, because consumers are paying them more to do so. Can you describe the reputational risk to credit agencies such as yours and the broader market implications of intentionally distorting those ratings? Mr. Linnell, I'll let you go first.
Yeah, in simple terms, you'll be out of business. You won't have a long-term viable future if you just simply inflate all your ratings to win business. And that's why you can see, for us, we have a low market share in many sectors because we have a different credit view.
Right. So in short, it doesn't make sense to take a few extra dollars today if it might destroy the entirety of your business going forward should investors fail to be able to rely on the ratings that you provide.
Professional investors are not stupid. They can see when there's rating inflation and what's happening. Investors want to see credible credit ratings backed by a long-term record, and that's what we try and compete, and that's what we try and provide.
Mr. Nadler, any comments from you?
I think that's absolutely true, and I think using the description that Chairman Sherman started with was of the baseball game, where I go back to my statement with the umpires paid $1 million and he calls the game wrong and everyone knows it. Nobody's going to show up for the next game. Nobody's going to watch. And so that's the same thing that would happen to rating agencies. Investors would very quickly lose interest in seeing that rating agency on any of the issues that they were willing to buy or pay for.
Yeah, exactly. So this is the same incentive structure that many other businesses have, and you have all the reason in the world to not sacrifice the long-term viability of your business for a few small, short-term gains. And with that, I'll yield back.
Now recognize the very patient gentleman from Ohio, Mr. Gonzalez.
Thank you, Mr. Chairman, for holding this hearing today, and thank you to our witnesses for your participation. While I certainly have concerns with the legislation attached to today's hearing, in particular the Commercial Credit Rating Reform Act, I think it is important that this committee continues to provide proper oversight of NRSROs. We should want a marketplace that has strong competition and transparency to help market participants make smarter investment decisions. I want to start with Mr. Bright with my first question. In June 2020, the SEC Fixed Income Market Structure Advisory Committee released recommendations on how to mitigate conflicts of interest in credit rating agencies. I think that's important. One of the recommendations was to enhance issuer disclosures, detailing the process issuers use to select an NRSRO. Do you have a view on this recommendation and how there could be additional disclosures for issuers?
There are a lot of disclosures. Okay, so if you look at a deal, I mean, it's hundreds of pages of information. The problem with that quantity of information is sometimes it's not exactly what you want. So I think that an iterative process that involves investors and involves the SEC and involves the credit rating agencies about what they're going to explain to investors in terms of how they selected the NRSRO for a deal, I think that we have a lot of support from our membership on that. I don't have a template, but we can. But I think it's a worthy conversation piece for sure.
Good. Well, who's on the other side of that? Because it seems like an obvious answer. I mean, what's the argument against something like that?
I mean, these things it's just resources and time, but I don't think it's prohibitive resources and time. Yeah.
Okay. That same report discussed recommendations for bringing more transparency to NRSRO models by requiring NRSROs to disclose more in-depth information about their models specifically and how they differ by industry. Do you have a perspective on that recommendation, especially in the context of how NRSROs already make their methodologies freely and publicly available?
Yeah, I mean, at some point that it can get a little weedy. So it's not a binary thing where I would say absolutely not or absolutely so. I do think it's important to know, though, that models are not right ever. I mean, by definition, a model is to take a universe of infinite variables and distill it down to the 50 you think matter most likely. And so you just want to have a conversation about what assumptions are going in, what empirical data you have or don't have for it, and what criteria you use around that in terms of making a decision. That's the important thing.
Yeah, it reminds me of a professor I had, Keith Hennessy, who used to work for President Bush, and he said, when people talk about their models, it sounds like this wonderful, deeply accurate thing. If you just translate that as spreadsheet, you're starting to actually get more what it is. It's just at the end of the day, somebody's best set of.
Fermilab has some good models. I would say for Congressman.
I'm not saying all models are bad. I'm just suggesting that they're made by humans and they are always inaccurate, though helpful in making decisions. Last question for me. In your testimony, you state that your organization found that alternative compensation schemes, such as the investor subscription model and an assignment model, presented even greater risks and consequences than that of the existing system. Can you just sort of double click on that and go through
very quickly? So again, the assignment model, degradation of quality standards, no incentive for a rating agency to have to sell, and explain its models and methodologies and criteria to the investor. So that kind of goes away. It's just once you're in, as I understand it, once you're in, that's a rotational thing. That said, as I mentioned in my testimony, Mr. Chairman, we will discuss it. We'll take it and further analyze that. The investor pay model, there's a lot of conflicts there, right? I mean, an investor who owns a bond has a particular interest in how it's rated. An investor that doesn't own a bond but wants purchase a bond would have a different interest. And so it presents conflicts of interest that could be problematic as well. So it's really more about, I think, having a robust dialogue between the rating agencies and the investors to make sure that the whole thing works as well as possible.
Yeah, no, I appreciate that, and I tend to agree. And like I said, this is not a perfect system. There's no perfect way to do this, I think, that anybody's come up with. But you know, to some of the earlier points, the legislation is, in particular, the assignment model, I just frankly think is nuts. But you know, with that, I'll yield back.
Thank you. We are honored with the presence of the chair of the full committee, Ms. Waters, who's recognized for 5 minutes.
Thank you very much, and I appreciate that so much, Mr. Sherman. Mr. Linnell, in 2011, your firm settled with CalPERS for providing inflated ratings for structured investment vehicles in the years leading up to the financial crisis. These inflated ratings led to a $1 billion loss for CalPERS, which managed the retirement savings of government employees and their families in my home state. In the decades since the crisis, does Fitch have any regrets about how its ratings harmed my constituents? Mr. Linnell?
Sorry, are you sure it was us that rated the structured vehicle that you're talking about? Are you sure it was Fitch? Are you sure it was Fitch?
I'm sure that in 2011, your firm settled with CalPERS. CalPERS is California State Public Employees Retirement System. And that amounted to, let's see, these inflated ratings led to $1 billion loss. That's why you had to get involved with a settlement. You don't recall this? You don't know anything about this?
I think the settlement that we made with CalPERS was very, very, very small. But you know, the structured investment vehicle sector, which was very large at that moment in time leading to the financial crisis, was one of the areas where Fitch had a much more conservative approach to S&P and Moody's that dominated that space. Typically, our ratings would not be any higher than single A. The standard for that market was AAA. So we had a very small market. Whether our rating was still too high in retrospect for that structured vehicle that CalPERS had exposure to, then obviously we were not happy that the ratings performed in that way. And if your constituents lost money as a result of that, then I'm sorry.
Okay, I'm sorry too. But let me just go ahead and tell you that the Financial Crisis Inquiry Commission reported that in the lead up to the financial crisis and Great Recession, the machine turning out collateral debt obligations that are CDOs would not have worked without the stamp of approval given to these deals by 3 leading rating agencies, Moody's, S&P, and Fitch. And as we painfully learned, these CDOs were time bombs that brought down our economy. So rather than sorry, which I have an appreciation for, what can you say about what you have learned, how you prevent the kind of actions that were taken that caused PERS to harm all of those who were depending on retirement funds? What have you learned, and what advice do you have? Did you give? What did you do different? What have you done to correct and not be involved that way anymore?
Well, I would say that that a large amount of our ratings portfolio going into the financial crisis, including the CDO market, actually held up pretty well. The ratings performed pretty decently given this supreme stress that the markets went through in the financial crisis. Our non-performance of our ratings was heavily concentrated in the US RMBS transactions, and to a small extent, the small CDO portfolio in synthetic CDOs that we had. But what we learned was that our criteria needed to be more conservative, that we needed to make the rating process more robust, and we needed to be more transparent about the key rating drivers and sensitivities that our ratings represent. And we have substantially increased our levels of disclosure to address those issues. And if you look at the performance of those very same asset classes during COVID, the default rate of our US CLOs, sorry, not default rate, but the downgrade rate of our US CDOs is currently less than 0.5%, despite the COVID impact being probably the biggest macro shock we've seen since the Second World War.
Have you in any way shown your appreciation for the fact that we bailed you out?
You bailed us out? How?
We bailed you out.
As an industry or the economy? Sorry.
I beg your pardon.
When you say we bailed you out, do you mean that you bailed out the economy because of the massive policy response to COVID?
Yes. Yes.
Yeah, that's been a huge. Yes, sorry, that's been a huge credit positive. I wouldn't say you bailed us out, but clearly the huge amount of government intervention around the world has been a tremendous success in building a bridge between a pre-COVID world and a post-COVID economy. And that is a real credit factor that needs to be reflected in people's analytics. Without that, then yes, the macro shock would have been much more severe and rating downgrades and ultimately credit losses would have been higher. But our ratings would have not predicted a global pandemic.
My time has expired, but I think that the revelations about your role and how we bailed out the economy, as you referred to, is something that we must always be aware of, take into consideration, and never get in that position again. I yield back.
Thank you. I will now recognize Mr. Mooney from Virginia.
Thank you, Mr. Chair. West Virginia. 1965, we separated out. No, 1865.
Congrats on that.
1865, yes. Bond rating agencies play an essential role in our financial markets. They measure the risks that influence investment decisions for everyone, from a hedge fund to a small dollar retail investor. Our focus on committee should be ensuring that bond rating agencies do their job by properly weighing those risks. I think that the general goal of better, more accurate credit rating is one that both sides of the aisle can generally agree upon. That's why I was surprised to see the quote, Accurate Climate Risk Information Act notice for this hearing. That bill would direct the SEC to adopt rules dictating how bond rating agencies should measure climate risk. Let me ask the question of Mr. Linnell. If credit ratings were less reliable due to political interference, what would that mean for the broader financial sector?
I think any impediment on the independence and the integrity of credit ratings would just reduce their value and their contribution to the financial sector. Simple as that.
Okay. Thank you, Mr. Linnell. I'm very concerned that Democrats' efforts to politicize the credit rating process. For Democrats in Congress to make a top-down ruling on climate risk would have damaging effects. With all due respect to my colleagues across the aisle, they are not experts in measuring risk. Leave that to the bond rating agencies. I'm also concerned about how the Democrats' climate rules could impact industries in my district like coal. Despite continued innovations in energy like carbon capture, which makes using coal environmentally friendly, Democrats continue to ostracize the coal industry that is important to districts like mine across the country. This bill is nothing more than another attempt by Democrats to insert their leftist ideology into another aspect of the financial market. They've pursued the same strategy with public disclosures, and now they're going after bond ratings. We should leave left-wing politics out of the regulation of bond rating agencies, let them focus on properly weighing risk in our economy. Doing otherwise is unfair to investors and unfair to important industries in my district like coal. Thank you, Mr. Chairman, and I yield back the balance of my time.
Thank you for yielding back. I now recognize the ranking member for a 2-minute closing statement.
Thank you, Mr. Chairman. Glad that we could have this conversation again. Some interest, my friend from California had talked about how the world has changed And I would agree. We are certainly financially in a different place than we were from 2008, end of 2008, going into 2009. And appropriately, we have tighter regulations. We have closer oversight by the SEC. We have seen the SEC and GAO do a study that that looked into various models. They concluded it could create incentives that run contrary to the goal of ratings quality. That's why they issued these non-enforcement letters. I kind of draw on some of my own personal experience and when I graduated with my also employable political science degree coming out of college. Usually political science majors chuckle at that because they know exactly what I'm talking about. I went into real estate. My family's been involved in construction for 3 generations. I've done real estate developing and building, number of things. And there was a lot of changes happening in that industry, including appraisals and how they ended up putting a rotation of appraisals in. It hasn't worked because you have people who don't know the market, they don't know the area, they don't know the context and the circumstances, making decisions that are affecting those things. I'm afraid that's exactly what might happen here. Here's a couple of things that we know have not changed. There's still natural disasters, but materiality is still reigns supreme, and a rotational assignment model is still a bad idea. One last thing, Mr. Chairman, it is important. I do have a couple of articles that I would like to put into the submit for the record. But I do want to clarify that Fitch, quote, settled, and I use the air quotes around that for you, Mr. Illian, because there was no payment to CalPERS with that settlement. There was no admission of guilt. It was just dropped, but that was deemed a, quote, settlement. So with that, Mr. Chairman, without objection, I would like to submit the following statements for the record. A written statement by S&P Global Ratings and then also a letter on behalf of Moody's Investors Service. The report that I had talked about in the opening, my opening, a report from PPI, which is the Progressive Policy Institute, titled Credit Rating Agencies Sending a Clear Signal. An opinion article from former Democrat SEC Commissioner Roel Campos titled, We Should Not Initiate Risky Experiments in the Credit Markets. And finally, a report from the Committee on Capital Markets Regulation entitled The Role of Credit Rating Agencies During COVID-19.
Without objection, those matters will be added to the record of the hearing. I now recognize myself for a closing statement. It is my intention to hold another hearing on this subject just as soon as we can get Moody's and S&P to show up. And by show up, I don't mean just send a letter to be included in the record. I point out that while the federal government did not write a check to any of the bond rating agencies, both in 2008 and in 2020, many hundreds of billions of dollars were invested by the federal government, thus bailing out the credit markets and preventing what would have been a huge rash of downgrades that otherwise would have occurred and would have affected the reputation of the bond rating agencies. I strongly disagree with Mr. Linnell when he says that it's just fine if a rating is expressed as big A, small a, 3, epsilon, omega, or something else equally confusing on the theory that bond ratings should only be read by the professionals on Wall Street. If I'm in a bond fund, they send me a list of all the bonds they own and the ratings. If I'm a part of a pension plan, I have a right to know how the money's invested and how the bonds are rated. And to say that things should be deliberately confusing shows a contempt for ordinary Americans. I also think that Mr. Linnell was very interesting when he pointed out that his rating agency is more conservative than his competitors in rating certain classes of debt instruments. And so they don't get that portion of the market. Those debt instruments go to his competitors. that proves that while perhaps the integrity of Fitch as to those particular instruments, but it shows the bias in the system. You can get the liberal rating, you just can't get it from Fitch. As to the baseball analogies, I do not think that if the umpires were paid and selected by one of the teams, that nothing Kershaw threw would be a ball. But there is the risk that the strike zone would just be an inch wider. That is why professional baseball won't let one of the teams buy a dinner for an umpire, yet we, in our capital allocation system, allow for the bond rating agency to be selected and paid by the issuer. There are two systems to control this. One is liability. If we don't need liability, why are accountants held liable or our auditors held liable? They have the same level of personal integrity. If personal integrity is enough, then why are we subjecting them to lawsuits? The other way to do it is through selection and having a panel selection process similar to what we do for bankruptcy trustees. But to leave this in a circumstance where the umpire is incredibly well paid, where the umpire is selected and paid by one of the teams, was a disaster for our country in 2008 and was a primary cause of a financial disaster that is still affecting America today in tragic ways. So I look forward to another hearing. I look forward to the CEOs of Moody's and S&P joining us. And this hearing is hereby adjourned.